Rob Scott is Managing Director and CEO at Wesfarmers, joining us live in this first on CNBC conversation. Rob, thank you so much for taking out the time to talk to me today. So I do want to kick off with a bit of a pulse check in terms of consumers, because we do that a lot these days in many markets. What did you learn about your consumers in the latest period? And do you think looming tax cuts in Australia could be helpful in terms of boosting demand?
Well, what we've been observing over the last year is we've seen some fairly strong wage growth in Australia. There's been fairly high population growth. So there's a level of spending capacity there amongst households. But people are very value conscious because of the higher inflation that we've seen and higher interest rates. People are really looking for value. So one of the key features of our result, our retail businesses are market leaders as it relates to lowest prices. And that lowest price positioning has resonated really well. And I would give that credit for reasons why our retail businesses delivered improvements in sales and earnings.
2/3 of your earnings comes from Bunnings, and that is the home improvement store operator. But you actually saw for the last 2 months or so growth moderating. Do you think that would actually continue, and in a deeper manner? What did you spot?
Well, Bunnings is still growing its sales, and although there's been a moderation, it's, I think, quite a credit to the Bunnings business and team that they're able to grow sales in the current market. What we're finding in Australia is that there's very depressed levels of residential construction, which is quite frustrating given that we desperately need more residential homes to meet the population demand. So the fact that Bunnings is able to grow sales in a challenging construction market really goes to show the positive nature and the diverse nature of the Bunnings business.
This is something that I mentioned right at the top, this cost of living pressures and following political scrutiny. Do you think it's fair for companies like Wesfarmers to be brought into the conversation and be asked for better prices for consumers as well as suppliers?
Well, it's interesting that in many countries around the world, during times of cost of living pressure, it's understandable that different politicians or regulators may ask questions around retail pricing. Now, I am a bit surprised that Bunnings has been mentioned for review, given that Bunnings for a number of decades has really built its reputation on lowest prices, and we have very strong price comparison and price guarantee arrangements in place to justify that claim of having the lowest prices. So if there is a review, we'll obviously cooperate with any review, and I'm confident that that review will really highlight the strength of our pricing position and the value that we offer customers.
Do you feel the risk of being a large conglomerate? Because a couple of months ago, I remember reading about how an Australian Senate inquiry is considering whether to basically make it easier in terms of the legal framework so that competition regulators can ask to break up large conglomerates like Wesfarmers. And can you just tell us whether if this kind of conversation is ongoing as we speak?
Well, there have been some questions asked by some politicians on whether there would be merit or benefits for consumers of breaking up large retailers, not exclusively conglomerates, but any large retailers. Now, I guess what we would argue is that it's by virtue of our scale that we are able to deliver the lowest prices. We have a fantastic track record around delivering lowest prices. And if we were forced to break up our business, I think the consequence of that would most likely be less scale, less competitiveness, and higher prices. And I think it's also worth remembering that we operate in a very dynamic retail environment where, in addition to a lot of local retailers, we face some of the biggest names in international retail right here in Australia, along the lines of Amazon, Temu, Costco, and so forth. But really what matters for us is to keep our prices as low as possible.
Talk to us about your lithium business running at a loss. I mean, obviously, it's the poor timing of the industry. Where do you see any pickup in lithium prices?
Well, it was interesting when we made the investment in our lithium mine and made the commitment to invest in an integrated refinery. Lithium prices were about where they are now. So, we made the initial investment on the basis of prices not far off where they are now. And we are still in the construction phase of our refinery. We're due to complete the construction at the end of this financial year. So we still feel quite optimistic about the prospects for our project. You're right that obviously lithium prices are quite depressed. We're seeing a number of producers either shut production or cancel mine expansions. I think it is likely that if we see more of that occur, having a big supply response will mean that there isn't enough supply to meet the ongoing growing demand. So I suspect we'll see a fair bit of volatility in lithium pricing, not just down but up, in the coming years.